The current market for Unity Software Inc., New York Stock Exchange, ticker symbol U, is displaying significant volatility this morning, with the stock trading in pre-market at approximately $40.30, which represents a substantial pre-market jump of over 12% from its previous close of $35.87 on November 4th. The market is clearly reacting to something big, and what most casual investors expected, a quiet lead-up to their earnings report later today, has been totally upended. The real insight here, the immediate angle that separates the sophisticated trader from the general crowd, is not just the earnings date, which is today, November 5th, but the early, extremely positive sentiment around the company's recent strategic shifts, specifically the early leaks and whispers about the success of their advertising platform, Vector AI, and the market's sudden belief that the disastrous runtime fee saga is now firmly in the rearview mirror. This massive pre-market move is not simply pre-earnings hype. It suggests that major institutional players have compelling evidence or a strong conviction that the results will not just beat consensus, but also contain forward guidance that definitively signals a profitable shift in the business model's foundation, moving from the choppy waters of game engine fees to the much more stable and higher margin realm of ad tech and enterprise application. The general belief about Unity for the last several quarters has been one of extreme caution. Investors saw a company with a dominant position in the gaming engine market, a critical tool for everything from indie titles to major mobile hits, but one that was constantly struggling with profitability, aggressive spending, and a very public, confidence-shattering misstep with their proposed runtime fee last year. The prevailing expectation was that the company would deliver a slightly better than expected quarter, maybe guiding towards break-even by late next year, and the stock would grind out a modest 3 to 5% gain. This pre-market surge of over 12% is a complete contradiction to that expectation, forcing us to rethink the entire narrative. The deeper take is that the new CEO and the restructuring efforts, which included significant layoffs and a sharper focus on core profitability, have already yielded fruit faster than anyone on the street outside of a select few had modeled. It's a classic expectation versus reality tension, where reality is exceeding expectations dramatically, specifically on the timeline for financial stability. The market is now quickly repricing U stock, not as a growth-at-all-costs software company, but as an emergingly profitable infrastructure play for the entire real-time 3D content space, spanning gaming and the industry NVIDIA stock-influenced digital twin and simulation markets. Let's look at the recent stock movement. The stock had been trading in a relatively tight range over the last few weeks, fluctuating between the mid-$35 and low $38 level, showing a clear hesitation among traders ahead of the earnings call. Trading volumes in the run-up were slightly above average, suggesting a slow buildup of positions, but nothing that signaled a major impending move until this morning. The sudden spike in pre-market volume, now easily surpassing the average daily volume from the last month, points to significant institutional activity. Large block trades are likely driving this, suggesting that firms like Fidelity Investments or those managing large intelligent portfolios allocations are either initiating new positions or aggressively adding to existing ones based on proprietary insights or a strong conviction about the forward-looking statements expected later today. This institutional confidence is the critical signal. When big individual brokerage firms start moving like this, it's a sign that the fundamental risk assessment for the company has been revised downward, and the probability of a successful turnaround is now viewed as high. The immediate daily swings in the stock have been incredibly sensitive to news, a characteristic of a high-beta, high-volatility stock like Unity. Just a few weeks ago, the stock experienced a sharp, nearly 10% pullback following news of a key executive departure, demonstrating how fragile investor sentiment was. Conversely, a modest analyst upgrade from a smaller firm resulted in a 4% pop a few days later. This current massive upswing, however, is qualitatively different because it's happening right before the curtain is about to rise on a major event, suggesting a significant information edge is being being traded on, a true belief in a game-changer moment for their financials, even if we are avoiding that buzzword. The entire move reframes the discussion. It's no longer about whether Unity can survive the PR fallout from the runtime fee. It's about how quickly they can scale the profitability of their non-engine businesses, particularly their Grow segment, which includes their ad tech platform, and how this will fundamentally change their valuation multiples, which currently look stretched against traditional metrics but suddenly become compelling when compared to successful ad tech or platform companies. Zooming out to the bigger picture, the Unity business model is deceptively simple but structurally complex. At its core, Unity provides a platform for creating and operating interactive, real-time 2D and 3D content. The Create Solutions segment is the engine itself, a subscription service that is essentially the industry standard for a huge portion of mobile and indie gaming, and increasingly for non-gaming applications in architecture, automotive, and film. Think digital twins and industrial simulations, which are also massive growth areas for companies like NVIDIA stock. The Grow Solutions segment is where the real near-term profit potential lies. This segment helps developers manage and monetize their content primarily through advertising services. This is where the company's new Vector AI advertising platform is showing early promise. The narrative is a two-part play: the stable, foundational subscription revenue from the Create segment and the high-growth, high-margin revenue from the Grow segment, particularly the advertising component, which is less tied to the one-off sales cycles of gaming hardware like the Apple stock iPhone or a new console. Older reports and past performance paint a picture of a company with consistent, albeit often decelerating revenue growth paired with persistent operating losses due to heavy investment in R&D and sales infrastructure. The controversy surrounding the runtime fee, essentially a fee based on game installs beyond a certain threshold, was a desperate and poorly executed attempt to turn those losses into profit by monetizing the massive installed base of the engine. The reaction was immediate, severe, and a huge lesson in the power of the developer community. The swift reversal, followed by a clear, sustained commitment to cost control and a renewed focus on the less controversial, more scalable ad tech business, shows a management team that is learning, albeit painfully. This learning curve is priced into the historical volatility of the stock, but the present pre-market action suggests the market is willing to forgive past sins for a truly compelling glimpse of future profitability. For investors who manage their own capital using platforms like Robinhood or SoFi Invest, or for those who use a service like Schwab Intelligent Portfolios, this internal debate is intense. Is this surge a justifiable move toward a new valuation floor, or simply a temporary earnings-related spike that will fade after the call? The shift in focus to enterprise and non-gaming applications is a subtle but profound change in the company's long-term structure. While gaming is their bread and butter, the long-term, high-value contracts are in the digital twin space, working with manufacturers, builders, and designers to create real-time simulations. This is a higher barrier to entry, stickier customer base with less volatility than the hit-driven game market. The ability to cross-sell their Grow solutions to these enterprise customers is a significant, yet often overlooked catalyst for sustainable growth. The advertising side, especially the new Vector AI platform, is the key short-term profitability lever. If today's earnings call reveals stronger than expected traction here, higher yield on ad placements, better retention rates for advertisers, and a clear path to taking market share from competitors, then the 12% pre-market move will be fully justified. This would mean that Unity's data assets, their unique view into the behavior of billions of users across thousands of applications, are finally being effectively monetized through smart algorithms and a much more focused sales approach. Future outlook scenarios for Unity are now centered on three possible outcomes following the earnings release. Scenario 1, the expectation exceeded, the current pre-market thesis. The company reports a significant beat on the top and bottom lines, driven by the Grow segment, and, critically, provides strong full-year profitability guidance that is well ahead of consensus, signaling a sustainable financial turnaround. The stock would likely break above the $42 to $43 resistance and establish a new trading channel in the mid-40s. Catalysts here are confirmed vector AI success and a clear, unified leadership message. Scenario 2, the soft landing, the cautious bull case. The company beats on revenue but only meets on adjusted EBITDA, reiterating the previously vague profitability timeline. The stock would see a sell the news event, likely falling back to the $38 to $39 range, as the pre-market hype dissipates without a substantial forward guidance commitment. Risks are an ambiguous CEO message or an underwhelming forecast for the Create segment's subscriber growth. Scenario 3, the reality check, the bear case. A major miss, or more likely a strong quarter, is overshadowed by a cautious or even